Trying to bounce back from a four-day losing streak on the S&P 500. Live from New York City this morning. Good morning, good morning. Your equity market positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, looking for a bounce after the worst week since March. Recession calls on Wall Street dropping like flies, and the Fed debate shifts from how high to how long. We begin with the big issue: recession delayed or recession avoided.
Whether or not we end up getting a recession this year, is up for debate.
I'm still in the recession camp.
That soft landing camp.
The no landing camp.
I feel torn about it.
We still think we're headed for recession.
Recession sometime over the next 12 months.
Sometime right around year end.
It may show up at some point.
If there was going to be a recession,
that is getting pushed out.
A lot of people have pushed it off the table.
At the moment, the likelihood of a recession is pretty small.
A softish landing is what's going to happen.
A soft landing.
Soft landing.
Slower growth, but nothing too bad.
The marketplace favors at the margin the softer landing interpretation.
The soft landing camp is definitely winning out here.
Boy, this is a very, very finely balanced call between soft landing and recession.
Joining us now to discuss JP Morgan's Oksana Aronoff, Keith Lerner of Truist. Oksana, first to you. Is it recession avoided or simply just delayed?
Good morning, Jonathan. You may recall our conversation much earlier this year when I had said that the last time so many influential people said something was going to be as great as this bond market was expected to be was the Fyre Fest. And I think that's exactly what we've seen. And our view had been earlier this year that the economy will prove to be stronger than what was being priced in, that Fed cuts were not going to materialize to the aggressive extent that was being priced in. And that's exactly what we've seen so far this year. So, of course, now the calls for recession this year have been pushed out, as they have been really for much of the year, by a few months. But I think what's much more important than the sort of inflationista versus recessionista battle of this year is really if we pick up our eyes and look a little bit farther out to the horizon and see that this fiscal spending that's certainly, contributing to this move in yields, along with a number of other factors for sure, but that this fiscal spending is not likely to stop, that the demands in the public purse are going to continue long term, and they're going to continue stoking, long run higher inflation. That doesn't mean we're going to go into any kind of an inflation spiral, but it does mean there will be more volatility to interest rates, to the bond markets, and that the last decade is nothing like what the next decade is going to be like for fixed income investors.
Keith Lerner, Mike Gapin, Bank of America, Mike Ferroli, JP Morgan, the Fed staff all dropping their recession calls over the last week or so. From your perspective, Keith, just to build on what Oksana was talking about moments ago, how much of that has been about fiscal policy specifically?
Oh, great to be with you, Jonathan. I think a lot of it is, when we look at this cycle, one of the things coming in this year, we said keep an open mind because the playbook is different than the more recent cycles we've seen. And I think the fiscal stimulus, for the reasons just mentioned, have been underestimated. But I think the other side of it as well is that the economy, at least so far, has proven less interest rate sensitive as corporations have locked in rates, as the excess savings have been there, as well as a lot of individual consumers have locked in mortgage rates as well. So I think that's actually just as big of a surprise relative to the fiscal stimulus, which has kept this economy stronger for longer.
Keith, accumulated savings, stronger balance sheets, residential for consumers, for houses, for people at home. Elsewhere, corporate balance sheets stronger as well. They pushed out some of their debt. They locked in low rates for a longer period of time. Is the sovereign balance sheet, Keith, weaker? Is that where the risk is?
I think it is certainly weaker, but even as far as the Fitch downgrade, I don't think that changes as far as the ability for the U.S. to pay its near-term debt. I think this is a longer-term challenge, and I think where that's going to manifest itself is likely as we head into September, and we're going to start talking about Washington a lot more, and the probabilities of a government shutdown is rising. Now, when we look back historically, that creates a lot of volatility for the market, typically a short-term hiccup. But to your question directly, Jonathan, weaker fiscal condition, but I don't think that's going to be the near-term impetus to make changes as far as the economy or for markets.
Big moves in the bond market last week. This morning, yields higher by, let's call it 3 basis points on a 10-year, 4.07% on 10s on a 2-year right now on the screen, higher by 3 basis points to about 480. Oksana, from your standpoint, where is that risk? Is it in credit or is it in sovereigns at the moment?
It is really both, because there is no impetus, again, for the Fed to really do anything here. You have a strong economy, you have strong housing, you have low labor, unemployment, essentially. And so there's really nothing to point to say that, look, this is recession right here, or this is weakness right here, or this is why the Fed needs to cut right now. And without Fed cuts, we're going to see this market try to stand on its own, which means it will have to reprice to the longer-term expectations for higher growth and some of these other issues around fiscal spending, as well as the fact that the other two huge anchors, the ECB and the BOJ, are also normalizing their policy, pushing rates higher. So I think interest rates will continue to be a risk for sure, and we're likely not done here. This bear steepener may have some more room to run. But the credit cycle is also underway for sure, right? We saw the bankruptcy of Yellow this morning, and that's just one of a string of bankruptcies that has continued to be kind of a steady drumbeat against the backdrop of this stronger economy. The lower-rated credit companies are certainly beginning to struggle. We've seen the default rate triple, albeit from incredibly low levels in the beginning of this year. But the credit cycle is underway, and we think that the credit repricing, the corporate credit repricing, will happen, frankly, irrespective of whether you see a broader recession or not, simply because these lower-rated borrowers are going to really struggle to find cheap financing in this higher rate world. And I think that will open up very attractive opportunities for credit investors. We've seen even since the beginning of this year, the very weakest part of the high yield market, the triple Cs, have jumped, very significantly in their spreads compared to some of the better quality names in that part of the market. So you do see kind of the weakest leading in terms of that spread widening. We haven't seen that spread widening anywhere else in the market yet, but we do believe it's coming. For investors who have liquidity, there will be a really great opportunity out there in the next 6 to 12 months.
Well, let's talk about the journey so far. Pre-SVB, I remember catching up with you, Oksana. You said all the good stuff is priced. There's going to be a problem in credit. Spreads then for high yield in and around 390. They gapped out, went through 5 percentage points or something like that, then all the way back down again. What's been behind the compression, the narrowing that we've seen, Oksana, coming out the other side?
So definitely there's not been a ton of issuance, and to the extent that investors are still looking for ways to increase yield in their portfolios, that's definitely been an attractive place, especially against the backdrop, as you said, of this sort of rhetoric of stronger balance sheets, which I think is absolutely true. Generally, the corporate landscape came into this with stronger balance sheets. However, a lot of the companies, particularly in that lower-rated part of the credit market, are going to struggle to find cheap financing, which they absolutely depend on to continue functioning. A lot of them, frankly, probably don't even need to exist and wouldn't have made it if it wasn't for the tremendous amount of stimulus in 2020 that allowed them to find that cheap source of refinancing. So it's a combination of demand and the fact that there hasn't been a lot of issuance because companies have balked at these higher yields, but they will not be able to hold out forever, and that's really when you're going to see the prices really take it on the chin.
22 minutes out from the opening bell, equities here higher by 0.4% on the S&P. Busy week of Fed speak and some data as well. Later on this week, CPI on Thursday, PPI on Friday. Mike McKee has more. Morning, Mike.
Good morning, John. Well, there's not a lot happening this week, but what is happening is going to get a lot of interest in the markets. We start the week with this. John Williams, president of the New York Fed, one of the big three on the Open Market Committee, talking with the New York Times, saying, of course, we're all data dependent, and based on what I see today, to me, the debate is really about, do we need to do another rate increase or not? That's going to be a question that we'll get some answers this week as we do get CPI later in the week. But look what's happening over the last couple of weeks. The yield curve is steepening as the markets begin to think about the Fed lowering rates at some point. Now, is it because of recession or is it because the real rate is going to creep up as inflation falls? The only thing I would say here is that the negative yield curve doesn't predict recessions. Recessions don't start until the yield curve starts to steepen, and that's what we're seeing right now. Something to worry about? We'll get another idea of what the market thinks this week when we have three auctions. Watch the 10-year and the 30-year. And the 30-year, John, has gone up about 30 basis points over the past week. Remember when that happened in Great Britain? We had some issues in the market. So far, nothing here. But keep an eye on what happens with those yields when those auctions take place. And then CPI, that's the big one this week. A lot of headlines are going to focus on the headline number, which is going to go up because of base effects. There was no inflation of July last year, but the Fed's going to be looking at the month-over-month number. Does it continue to go down? 0.2 is the forecast. If we get that, the Fed will be reassured that at least we're still making the same kind of progress. They do have one more CPI report before they have to vote again, but decline in CPI would give them a little bit more of a sanguinity, I guess you'd say, about where things are at the moment, as John Williams was talking about.
Mike McKee, thank you, buddy. Appreciate it. For the update on the Fed speak as well. The runway, the calendar, August 10th for CPI, September 13th. The next two CPI prints before that Fed meeting later on. Keith Lerner, let's start with the Fed debate. Let's go there. Is now the time to shift the debate from how high to how long rates will be this high?
Yeah, well, our story all this year was that the Fed was going to be higher for longer. And I think their reaction function will be slower to cut rates because of the inflation that we've seen over the last year. So I think the discussion right now is still, it's probably close to a coin flip as far as if they raise rates one more time. We think they're more likely to, but again, we have a lot of data between now and then, and that's likely it. We think they stay on hold. And what's interesting, Jonathan, on the other side of this cycle, since they're likely to be slower, we also think any type of economic rebound that you normally get from monetary policy being cut will be more constrained relative to history. And from a broader market perspective, I don't think this is the main driver right now. Again, we've just raised rates over 500 basis points, whether we do another quarter or not. To us, is not the main story. The main story in our view is earnings. Earnings have been stronger than expected, but again, we think we're more likely in a consolidation here near term.
Earnings better than expected, the data better than expected. Oksana, let's talk about the how high for how long, and the how long specifically. Oksana, I won't ask you how long you think the Fed is going to hold rates for, but I would like to know from the work that you've done, looking at the maturity profiles of corporate America, if there is a duration in time where this becomes really problematic for corporate America. Is that maturity wall 6 months out, a year out, 18 months out? How close is it?
So if we consider the fact that, of course, most of the defaults happen in the junk-rated part of the corporate sector, right? That maturity wall is coming up in 2025, and the market typically starts to anticipate who is going to be able to refinance and who is not, call it roughly a year out. So I think as long as rates remain here for the next, 6 months, 10 months, over the next year, call it, or less, it will become an increasingly more significant problem. And in terms of what history tells us, there is absolutely periods in very recent past, like the late 90s, for example, where the Fed kind of just held the Fed funds rate in that 4 to 5% range for several years, between roughly 95 and 99 or so, because inflation remained elevated, above 3%. And so it's not unconscionable that we could stay here with this. If the labor market continues to be strong, there's certainly no impetus for the Fed to deliver an easing. So it is absolutely not outside the realm of possibility that the Fed doesn't need to keep hiking. They just have absolutely every right to step back and say, all right, let's see what happens here. The economy has continued to be strong, and let's see how this unfolds. And that will be problematic for the weaker balance sheets that absolutely require that cheap financing and cannot exist without it.
Oksana, Keith, stick with us. Your equity market at the moment about 17 minutes out from the opening bow. Futures positive here by 0.5%. Let's get you some movers. Here's Abby.
Well, John, let's start out with the shares of Tesla, which are sort of all over the map. They had been up slightly. Now they're down about 0.7%. This after the company filed an 8K. They have named Vaibhav Taneja as the CFO. He is replacing Zachary Kirkhorn. Zachary Kirkhorn has been with the company for 13 years. He's stepping down after 4 years in the CFO role, but he will be sticking around through the end of the year. Berkshire Hathaway up about 1%, narrowing in on an all-time high. This, of course, as they reported earnings and their cash pile reached $147 billion. Operating profits jumped 7% on a year-over-year basis, so a positive quarter there. And then Palantir reporting after the bell, up 0.6%. Well, this is going to be a big AI test, John. The stock up about 135% on the year. Will the data analyzing company, will they be able to back up that gain with progress on AI?
Abby, thank you. Coming up on this program, the White House on Bidenomics.
We had record levels of recovery from the global pandemic and its ensuing economic catastrophe. And now we are seeing what steady, stable growth looks like.
President Biden pushing forward his economic agenda as the warnings pile up. That conversation up next.
This is steady, stable growth. It's what we would want in the economy, right? We had record levels of recovery from the global pandemic and its ensuing economic catastrophe. And now we are seeing what steady, stable growth looks like. 187,000 jobs created, bringing the total since President Biden came into office to 13.4 million, at the same time that we continue to see record low unemployment rates.
The White House promoting President Biden's economic agenda. Morgan Stanley's Mike Wilson has a warning. Fiscal dominance has been a key component of our boom-bust framework. This year, another strong fiscal impulse has reasserted itself. Should it reverse, it could call into question the significant reacceleration in growth that is now priced. Anna Wong of Bloomberg Economics echoing that sentiment, writing this: if the recession we predict this year is delayed rather than averted, and the Fed ultimately has to hike more than we currently anticipate, the most likely culprit will be Bidenomics. Kelly Lyons down in D.C. with more. Hey, Kelly.
Hey, John, therein lies the rub for President Biden, because right now, in theory, the economy is working in his favor with inflation coming down and the labor market and growth still incredibly resilient. And he does say that is due to Bidenomics, to the legislative accomplishments he has seen in this administration, the passage of the Inflation Reduction Act, of infrastructure spending, and the CHIPS Act as well. And that's the messaging he's going to be taking with him to the Southwest this week. He leaves for Arizona later this afternoon. Will be traveling to New Mexico and Utah as well, trying to promote this message that his policies are contributing to stronger economic growth. And economists do agree with him. The issue is, while it's working in the near term, it may not work as well in the long term. If, in theory, these policies continue to stimulate demand and inflation can't come back down to the Fed's target, could mean tighter policy for longer and ultimately a recession down the line, to the point that our own Anna Wong was making. You also have to consider other factors here as well. The idea that this fiscal stimulus comes with an increase to the debt load, and it's that very debt load that was one of the problems that Fitch pointed to last week when stripping the U.S. of its AAA credit rating. And there's some other economic factors that could come into the picture this fall. A government shutdown that is looking increasingly likely to happen should Congress not agree on spending packages, as well as the resumption of student loan repayments come October. Both of those forces could start working against the economy in theory. So while the Bidenomics messages is what the president is trying to tout at the moment, it is not yet reflecting in his approval rating on the economy or overall. And that could get more difficult as we get closer to 2024 and November, when he's seeking re-election, John.
Kelly, thanks for the wrap-up down in Washington, D.C. on the latest Bidenomics, the good and the bad, depending on what seat you're in at the moment. Keith Lerner, have you ever seen deficits this big with unemployment this low?
No, it's surprising, like I said, how resilient things have been. And again, I think one of the main things for this economy is just how strong this fiscal stimulus and how prolonged it's been. And a lot of the spending is still going to happen over the next several years. So it's overall, a strong economy. But that inflation, though, as we mentioned, it's going to be a lot tougher getting inflation from, say, 9 to 4% down to 2%. And I think that's going to be the challenge. And a lot of consumers, and as you go out into the election year, are still focused on these high prices. Even if inflation comes down, when you go to the grocery store, those prices are still a lot higher than they were a few years ago. So I think that's going to resonate. We're also seeing gas prices as well. And as we go back more near term, that CPI report, there's a chance we're actually on the headline number going to actually see a little bit of an increase, which is going to be a change from the trend we've seen over recent months.
The CPI on Thursday, PPI on Friday. Oksana, Jim Bianco of Bianco Research has said he thinks inflation is bottoming out for the year. He doesn't think from here that you're going to see a continued deceleration. What you'll see, to what Keith just said, is inflation picking up again into year end. Are you sensing the same thing?
I definitely think that that's a very distinct risk, and we are seeing, of course, energy prices perk back up, where there's a lot of questions around other commodity prices given the war in Ukraine and the wheat prices. But there's also kind of, John, a perfect storm around, to the extent that we are talking about interest rate levels, right? And that's why we're talking about inflation. It's the cost of capital, which of course impacts everything. There is kind of that perfect storm in the works right now, and inflation is just one of the moving parts. You've had this higher than expected amount of treasuries at auction, or the Treasury is going to need to borrow. You've had BOJ try to normalize its policy. You've had the ECB, of course, continuing to raise. You've had really a lot of tremendous amount of fiscal spending, as was mentioned, really unprecedented for non-war times. And so there are a lot of sort of things coming together. And one of them has been notably a rise in inflation expectations, right? So which kind of underpins or emphasizes the somewhat academic nature of the CPI, in that your average consumer may actually have a different, or may feel that they're having a different experience, which can unmoor inflation expectations. And we've certainly seen them move up. And that also then contributes to how the Fed thinks about it. What do they do here? So there are a lot of factors that are coming together right now to push that long end of the curve higher. And I think that will continue to be a risk. And that steepening may continue to have some more legs from here.
Interesting. Ahead of a ton of supply a little bit later this week. Oksana, Keith, wonderful to get your views to kick off the trading week. Going into the opening bell about 8 minutes away. This from Andrew Hollenhorst of Citi a little bit earlier this morning. Essentially, the message from them is it will look like a soft landing until it doesn't. A true soft landing, they say, involves inflation slowing to 2% while the economy avoids recession. They go on to say some economists and Fed policymakers see this as the most likely economic scenario, but in our view, it is the least well supported by empirical and theoretical evidence. The latest from Citi a little bit earlier. Coming up, the morning calls, and later, looking for some calm after that storm. Neuberger Berman's Ashok Bhatia joins us around the opening bell after 4 straight days of losses in the equity market. That conversation still ahead. Closing out things on last week with a 4-day losing streak on the S&P 500. Just going through my brain, I think that's the longest daily losing streak going back to something like May. Your equity market right now, on the equity market on the S&P, is positive by 0.3%. On the Nasdaq right now, positive by about 0.5. That's the equity market story. Let's get you some morning calls. Wells Fargo upgrading DraftKings to overweight, $37 price target, seeing a less competitive environment due to mounting consolidation. That stock is up by 2.3%. UBS upgrading Wayfair to buy, saying investors are overlooking an attractive valuation and favourable setup. And finally, Redburn downgrading American Airlines to neutral, expecting higher fuel prices and a competitive domestic market to serve as continuing headwinds. That stock is negative there by 0.5%. Coming up, seeking stability after the storm, Neuberger Berman's Ashok Bhatia joins us at the opening bell on where he's looking after the biggest weekly decline in the equity market since March, and a bond market that's been all over the place. Your opening bell just around the corner. Coming off the back of a 4-day losing streak on the S&P 500, longest daily losing streak back to May, the biggest weekly loss back to March on the S&P, and trying to bounce here by 0.5% on the S&P. A similar bounce on the Nasdaq 100. Will it stick? The fate of the equity market this week in the hands, maybe, of the CPI data on Thursday. There's the opening bell. Switch to the board and get to the bond market. What a move last week. Monday through Thursday, yields higher, then snapping back on Friday, then bouncing this morning and fading a touch. It's kind of been the journey of the last week or so. Up 3 basis points on a 10-year, 4.0682%. CPI Thursday, PPI on Friday. In the FX market, in the last 30 minutes, last hour, just about reclaiming 110 in the FX market. Through most of this morning, the dollar dominant, stronger against most of the majors in G10 at the moment in foreign exchange. That story turning more recently in the commodity market. Just briefly here, we're down 0.6%, down about 50 cents to $80.30. 30. About 30 seconds into the session, we do advance. We snap that losing streak. Let's see if it sticks. Up 0.5% on the S&P, on the Nasdaq, a similar move. One stock to watch at the open, Tyson Foods, posting a quarterly loss and shutting down an additional 4 plants amid slumping demand and rising prices. The company CFO calling it a difficult decision, but the right choice for the long-term future of the company. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Tyson shares absolutely plunging this morning, currently off by about 10-11% or so after reporting pain across the board. To get into some of the numbers here, posted a loss of $417 million in this past quarter. That compares to a profit of $750 million just a year earlier. Revenue declined by an as expected 2.6%, and third quarter sales also trailed, as you mentioned, in an effort to cut costs. Going to shut down those 4 additional chicken facilities. A tough decision, according to the CFO. But the headwinds here are pretty tough, John. If you take a look at cattle supplies, they're tight. And then on the other side, you have a glut of chicken and pork. And to put some context there, the average pork price fell by more than 16% from a year earlier. Chicken prices down 5.5%. You add it all together, bad news for America's biggest meat company. You can see that in the shares, currently off by more than 10%.
Stock getting butchered. You like that, Katie?
Oh, gosh.
Katie, that was brutal. All right, we're down 10%. Katie, thank you. Warren Buffett, benefiting from a surge in short-term interest rates. The billionaire's firm Berkshire Hathaway running this. We continue to believe that maintaining ample liquidity is paramount, and we insist on safety over yield with respect to short-term investments. Shonali has more. Hey, Shonali.
Hey, John, you're looking at Berkshire faring better than expected, even though Warren Buffett himself said earlier this year that you could have a tough year when you look at Berkshire's operating segments. But when you have so much money, more than $147 billion, near a record cash hoard sitting around, surely that surge in short-term rates really helps out Berkshire Hathaway, as does a rebound here in insurance underwriting profits. Now, I want to actually turn a little bit to another corner of the market, from Warren Buffett to KKR. The reason being is private equity has been long one of those reasons that Warren Buffett has had so much of a hard time using that cash hoard. And this idea of using insurance, taking that float and reinvesting it is a big reason you've seen Apollo, KKR dive into that same trade. And you have KKR shares also rising on the day. If you think about the $140 billion that Warren Buffett has sitting on the sidelines, you look at KKR and the unused funds, the dry powder is $100 billion. Over at Blackstone, that number is about $200 billion. Across the private equity industry, it's $2.5 trillion. So among both of these companies, you have to wonder how long it will be before they can meaningfully start putting money to work with hundreds of billions of dollars just sitting on the sidelines.
Shonali, thank you. That's the latest for Berkshire Hathaway and the rest. Elon Musk, a step closer to his cage fight with Meta CEO Mark Zuckerberg, maybe. Musk tweeting the fight will be live streamed on X. Then on Threads, Mark Zuckerberg said, shouldn't we use a more reliable platform that can actually raise money for charity? Ed Ludlow has more. Morning, Ed.
And then the next development after that, Jonathan, is Elon Musk taking to X in a post which basically means now that all bets are off in this proposed cage fight in the Octagon in Vegas. Musk is saying that he will have an MRI today on a historic neck and back injury that stems from a bout that he had in the sumo ring 8 years ago. And he shared a photo of this sumo bout and said that he was able to throw his Japanese counterpart. However, in the process, crushed his C5, C6 vertebrae. And they've been fused for a number of years with a titanium plate. He needs to investigate whether he gets that titanium plate tightened. So we don't know where we stand. As you know, Zuckerberg cast doubt on his own platform Threads that the fight would go ahead, because when Musk posed the challenge originally to Zuckerberg in June, Zuckerberg's response was, let's do it August 26th, and Musk has not responded to that. Dana White, the head of the UFC, has been involved, and as you know, he claims to have spoken to both parties who say to him that this fight is being taken seriously. That's where we stand. We'll continue to track it. I will be posting to Bloomberg's social media accounts shortly with the full details of the story. Big piece of breaking news, though, at the Open. Tesla, actually, it's pared its early losses in the session, but CFO Zach Kirkhorn has stepped down. And this is actually a big surprise. He has stepped down as CFO effective August 4th. He will be replaced by Tesla's chief accounting officer, Vaibhav Taneja, but he will stay on for the rest of the year to help with the transition. You know, Zach Kirkhorn has been at the heart of everything that's been good for Tesla, frankly, in the last 4 years as CFO since being named in 2019. He was a rookie then, an unknown quantity. But what he's done is basically brought regular profit to Tesla, done smart capital raises, and every investor and analyst I've spoken to has been a big fan of his in that time. So interesting news out of Tesla at the Open too.
Thanks for that, Ed. Some serious stuff. Tesla down by 0.9%. Elsewhere, Barbie is Warner Brothers' billion-dollar baby. Global ticket sales for the hit movie topping $1 billion over the weekend, becoming just the second movie to pass the mark this year, just behind the Super Mario Brothers movie released earlier in 2023. Abby has more. Hey, Abby.
Hey, John. And yeah, we do have Barbie joining not just Super Mario Brothers, but about 50 other films that have grossed more than $1 billion in global ticket sales, joining the likes of Titanic, Avatar, Jurassic Park, these real iconic films. So perhaps Barbie is on that trajectory. It certainly seems as though it is. And as you mentioned, it's just the second to do so this year. Confirmation came around 2 a.m. This morning from Warner Brothers. It happened yesterday in terms of surpassing $1 billion. Now, the stock is up about 8% since Barbie's release about 3 weeks ago, helped out by some of that Barbenheimer magic. A big accomplishment for sure for Greta Gerwig. This year, we have Warner Brothers, John, up 47%. The company, of course, merged last April. It's expected to be profitable in the fourth quarter. Relative to Mattel, up less on the year, up more than 10%. Today, though, Mattel up 1.8%. Its best day since July. The question will be whether or not Warner Brothers can give up some of the premium. Right now, it's trading at a huge premium to the group. It seems as though Barbie can help its numbers move in the right direction. I still have not seen this film, John, but I have had a couple people come up behind me and say, supposedly a big line in the movie, "Hey, Barbie."
I haven't seen it. But I will see it when it comes out on streaming. I just don't feel the need to go to the movie theatre and watch that just yet. About 7 or 8 minutes into the session, your equity market positive by 0.6%. Stocks looking to snap a 4-day losing streak after recording its worst week going back to March. RBC's Lori Calvasina says we're due for a pause.
We don't like where we are, sort of in the intermediate term. This just feels to me like a market. While I think everything has been deserved in terms of what we've done so far, it just feels like this market needs to stop, pause, have a little moment of digestion and catch its breath.
I'm pleased to say we can continue this conversation with Neuberger Berman's Ashok Bhatia. Ashok, wonderful to catch up with you, sir. It always is. A theme of the morning so far. Is it recession delayed or recession avoided?
Yeah, we have been in the camp that the U.S. economy is going to chug along at 2% types of growth levels. Inflation will fall slowly this year, and then there'll be more accelerated fall in inflation next year. So I think, this is still something for the U.S. that looks broadly like a soft landing. It's something that's not going to result in a very sharp rise in default rates. It's going to be something that should bring some stability into interest rates. I think a bit of the challenge is we are seeing some divergences globally. While the U.S. is certainly looking like, a soft landing continues to develop, there's a bit more weakness in Europe, particularly in core Europe, where both, the consumer sector, the manufacturing sector are seeing some weaknesses. And then China is also struggling to get growth rates back up. So I think it has in the last 6 months gotten to be a little bit more of a mixed message globally on the growth front. But the U.S., everything we see still looks pretty consistent with a soft landing.
Domestically, that view on a soft landing, can you just explain to me, is that a view of a soft landing with inflation returning to 2 or a Federal Reserve just tolerating 3?
Well, make 2 points. I think it's a view that inflation can get back to 2%, but that is more of a 2024 event than anything near term. So it is, we see a path back to the 2% upper bound of core PCE that the Fed targets. So we don't think this is going to be something where the Fed is going to have to, change its target or something like that. I think, but the second point is that, the bond market is basically pricing this sort of trajectory. It's pricing, if you look at what's embedded for Fed tightening and then easing. The bond market's really saying in the U.S. that inflation will be, 0.2, 0.3 monthly prints this year before something more rapid next year that allows the Fed to ease maybe 100 basis points, in the first half of next year to keep the real policy rate pretty stable. That all seems pretty reasonable to us and can be a scenario that's not very disruptive for markets if it plays out like that.
You suggested that defaults may not be that bad. my words, not yours, but you can give me some more color on that. We had a guest earlier on this hour, Oksana Aronoff of JP Morgan, who suggested, Ashok, there was a maturity wall out in 2025, that this market would begin to price 12 months out in early 2024. Why isn't that the way you look at things?
Well, that's absolutely the case. So, our base case is, default rates, and I'll just use the U.S., European high yield markets. They were around 1.5% default rates last year. We think they'll be around 2 to 3%, this year and next year. So modest increase, but, compared to long-term averages, this is still a pretty benign environment. I think that point about the maturities increasing in 2025 and 2026, absolutely correct. We are seeing at the margin some, high yield issuers where spreads are, pretty attractive, relatively low spreads. There is some movement to further extend those maturities. So it is possible if we get into, economic weakness next year that becomes a bigger issue. But, the flip side is that if growth continues to chug along at 2%, this can still be a relatively low default environment. I think the issues, and we think the issues with, the credit markets, it's really not a fundamental issue. It's simply that, spreads are at the low end, tight end of ranges. So it's more to us a question of relative value across these markets more than there's a fundamental issue brewing in the credit markets.
Well, we all have access to this information. We can go through the individual maturity profiles of individual companies. Are you beginning to see any dispersion whatsoever appear within high yield?
Yeah, we are seeing some themes. I think we're seeing businesses that maybe are, rich in assets, but maybe a little lighter on cash flow, where 2 years ago, the bond market would say, hey, this company's got a lot of assets. I'm maybe a little less concerned about cash flow. That's one theme we're seeing pressure. We're seeing pressure in legacy businesses. So things where, they are structurally declining businesses or structurally challenged businesses. Zero rate environment, bond market was willing to maybe look past that a little bit more challenges there. We're seeing challenges in, floating rate structures where the interest impact has happened and, cash flow declining. In some of those cases, equity owners are putting in a little bit more capital to keep the business, moving forward. So the rise in interest rates is having some impacts, and obviously the financial system, in March was in the news. But would say these issues have been more manageable. They're not leading broadly to defaults, but to relative negative price performance in some areas of the bond market.
Another area of the bond market we've seen a challenge is just in the sovereign bond market in Treasuries, not off the downgrade, Ashok, just off the additional supply we're now expecting. There's a ton of it this week. Do you think we're going to be able to absorb that additional supply with ease later this year, through this week and beyond?
I think so. 2 points on this. I think first, this challenges to governments, it's well known, and it is coming. I mean, the amount that the U.S. Treasury is going to spend on interest expense in the next 10 years, or the Congress, it's going to triple. So these challenges, I think, are well known, or at least they should be well known, and they are coming, and it will result, we think, in long-term or intermediate-term pressure and long rates. But I think the second thing that's also been brewing on this in the last week has been what's happened in global markets. This has coincided with the Bank of Japan relaxing its target for 10-year yields. We've seen steepening in that curve. We've also seen steepening in the European curves. So the U.S., we don't live in an island or isolated bond market, and steepening pressure from those two markets also bleeds into our market. And we think that's been one thing that's been going on, as well as the supply concerns.
Bond market's fascinating right now. Ashok, thank you. Appreciate the time, as always. Ashok Bhatia there of Neuberger Berman on fixed income, both credit and sovereigns. On the sovereign debt market, screen right now for Treasuries on my Bloomberg, yields are higher by about 3 basis points on a 10-year, just north of 4%. Coming up on the programme, Apple looking to bounce back after its biggest one-day drop of the year.
Longer term, the health of Apple remains very good. But as far as kind of what they're having to navigate through right now in terms of some of the challenges on the hardware side of things, that's something that they've been doing here for the last couple of quarters, and they're going to need to continue to contend with, at least in the near term.
That conversation up next.
The biggest positive takeaway from this earnings call was the services side of things, and I think most polls would point to that. Longer term, the health of Apple remains very good, but as far as kind of what they're having to navigate through right now in terms of some of the challenges on the hardware side of things, that's something that they've been doing here for the last couple of quarters, and they're going to need to continue to contend with, at least in the near term.
5-day losing streak for Apple, longest daily losing streak of the year so far. CFRA's Angelo Zeno expecting Apple to rebound from its worst week of the year. Shares falling for a 5th consecutive session after losing its grip on a $3 trillion market cap. All of this ahead of the iPhone 15 launch in less than 6 weeks' time. Dan Ives at Wedbush saying this: I believe this is just a pause. Selling Apple into the iPhone 15 cycle, in my opinion, is leaving the Super Bowl at half-time. Let's get to the team coverage. Ed Ludlow back with us alongside Bloomberg's Anurag Rana over in Chicago. Anurag, I want to come to you. Is that iPhone 15 going to solve all of their problems?
See, for Apple, I think one of the things people need to really understand that the next version of iPhone just accelerates the refresh cycle for a little bit. It doesn't really change the dynamics of the company. Now, the way we have always thought about this is an average iPhone user changes their iPhone at about 3.6 years. That doesn't change up, it goes up and down, but it's been very consistent for the last several years. So from our side, iPhone 15 is going to give a push. All the stuff that we are seeing, the lack of pressure in buying right now, we should see that in the fourth quarter or the December quarter, assuming we don't get into any supply chain problems. So I'm fairly optimistic that it's going to be fine.
This stock struggling just a little bit. Great year-to-date gains, up something like 40% before today. We trimmed those on Friday, but this morning down another 1.6%.
Yeah, and as you said, the fifth consecutive straight day of declines. You have to go back to December for the last time this stock was under that much pressure. It's interesting what Anurag said, because you have to match the backward-looking comments of executives on the call last week with their forward-looking comments. Luca Maestri, the CFO, said that in the US, the smartphone market had had 2 quarters of declines. And Tim Cook pinned some of the bigger macro weakness on that US market, contrasting it with China and India. Here's what we know. Here are the specifics that Bloomberg's reported about the iPhone 15. Should go on sale September 22nd. According to sources. That is after an event which we believe is planned for September 12th or 13th. It's interesting because if it does launch September 22nd, that would give Apple 1 week of sales in the fiscal fourth quarter ending in September. You're also interestingly lapping some comps with the period a year ago where, remember, the iPhone 14 Pro and 14 Pro Max were impacted by the second COVID wave in China at Foxconn's facility. And remember the story, John, I was on the show every day with you talking about this. The demand was for the higher-end Pro handsets on the 14, but they couldn't make them. They did not have the production disruption in the iPhone 14 standard version, but there was no demand there. In terms of what we know, the Pro model for the 15 is going to have a border that's about 1/3 thinner around the display, a titanium frame as opposed to a stainless steel frame, better camera, USB-C charging port, and a faster processor. Does the tech drive the upgrade cycle? And I think that's where we have some questions.
Is that enough to get us to upgrade? Ed, Anurag, to the two of you, thank you. No doubt we'll be staying on top of this story for the next couple of weeks going into the launch, if it is indeed in the back end of September. Let's get you some sector price action. We can do that now with Abby. Hey, Abby.
Hey, John. We have a very strong sector composition on this Monday. The overall gain for the S&P 500 up about 0.5%, but 10 of the 11 sectors are higher, led by communication services being helped out by the likes of Alphabet and some of those other mega cap tech stocks. Financials doing well, too, up 0.9%. Of course, Berkshire Hathaway put up that great quarter. Not doing so well, though. Consumer discretionary down slightly, so we can't really even talk too much about it. And same deal with energy. Digging into those financials just a little bit more, get some real strength for the banks. And of course, we do have yields modestly higher, but last week a big backup there is the financial sector up about 0.8%. Berkshire Hathaway really outperforming JP Morgan, Chase, and MasterCard doing well too, John.
A lift for the financials. Abby, thank you. Coming up next, your trading diary. Attempting to bounce, but it's not convincing, is it? About 25 minutes into the session, the S&P 500 just about positive by 0.5%. The Nasdaq lags just a little bit. We're positive there on the Nasdaq 100 by 0.46%. That's the price action. Here's the trading diary. Your week ahead. Philadelphia Fed President Patrick Harker, Richmond Fed President Tom Barkin. They'll be speaking through the next 24 hours. Plus, earnings from UPS and Rivian, followed by more results from Disney after the closing bell on Wednesday. Thursday, it's the main event. It's CPI. Thursday morning, you'll get some jobless claims data as well. And finally, we round out the week on Friday with PPI and UMich consumer sentiment survey data. From New York, that rounds out the morning for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.